Well, the market's at record highs. Those highs might get tested today as investors pay close attention to a handful of economic data that we're expecting. That includes the personal consumption expenditures, also that the number that the Fed looks at so closely. That is their preferred gauge of inflation. Ahead of that, you see the markets just a little weaker this morning. Dow futures are off by about 45. The S&P futures down by 12. The NASDAQ off by 70. Joining us right now is Peter Boockvar. He is the Chief Investment Officer at Bleakley Advisory Group. He's also a CNBC contributor. And, Peter, why don't we start off talking about the economy and the Fed? The Fed's positioning in all of this. We're going to get some numbers today, but we're at this weird inflection point where the Fed's been cutting rates. They've gotten a lot of criticism for cutting maybe faster than some people had anticipated. Now it sounds like they're slowing down, and you could be gearing up for some incoming pressure from them on the other side of things. Where do you think we stand right now? What's the Fed to do at this point? What's the economy look like to you?
So I see a two-lane economy. In the fast lane, you have the upper income consumer benefiting from having a job, high stock prices, high home prices. You have anything related to AI spend. You have anything related to government spending. In the slow lane, you have low to middle income consumers that are still struggling with the higher inflation that we've seen over the past 4 years. You have manufacturing that's in a recession. You have the pace of existing home sales that's at 30-year lows, and all the peripheral and ancillary activities that take place around the transaction of a house. You have global trade that's very muted. On the labor side, you have the pace of firings that's muted, but the pace of hirings that's slowing. So the Fed is looking at this somewhat confused situation, but they keep talking about being restrictive. Well, they're restrictive if you're in commercial real estate. They're restrictive if you're a small, medium-sized business. They're restrictive if you're trying to buy a house. But there's a party going on in the markets, and they are the opposite of restrictive when it comes to that. So how they balance that, I think they should not be cutting rates in December after already cutting 75, just to take a time out, because they can always cut again in January.
Is the lesson there that you need to be kind of a cold and callous Fed? Because if you're looking at the small and medium-sized businesses, that's where the bulk of hiring is in this nation. If you're looking at low to middle income and consumers, they're the ones who are feeling big pain on these issues. If you're looking at first-time home buyers who are trying desperately to get into the market, are those just problems that the Fed can't fix?
Well, that's the balancing act. The Fed should have learned when they cut in September, when long rates went up, that they are not in control of that entire yield curve. So they can try to get cute with short rates, hope long rates follow, but that's not what happened. So I think that if you're an owner of the 10-year Treasury, you want the Fed to be hawkish because you don't want them to lose control of this inflation fight, which they seem to be winning right now.
Right.
So the Fed, in a way, because so many market rates and lending rates are based on the long end, has to be really careful in taking the message that the market sent after that 50 basis point cut, the Treasury market,
where the long end is, we've seen
sort of went their own way,
go up ever since they started cutting on these.
And Powell at the last press conference, when he was asked about the rate move in response to his rate cuts, was rather dismissive. I don't think he should be so dismissive.
Can I ask what the Fed's balance sheet, what role it plays in any of this? Could they shrink the balance sheet and have any impact on any of this?
Well, what's amazing is, this QT that not only the Fed, but the Bank of England, the ECB, the Bank of Canada, Bank of Australia, they've all been doing it. But from a liquidity standpoint, it really hasn't had that much of an impact because markets are doing fine. Do we cross that line where at some point liquidity starts to drain? I think it's possible, particularly the BOJ is shrinking the size of their purchases. So the big question with the Fed, back to that, is when does the balance sheet stop shrinking? When is enough? And they don't even know. Powell says we know it when we'll see it.
Right.
But unfortunately, that may only happen when, right. So similar to 2019, it was only when there was a chaos in the repo market that they finally stopped shrinking it. But it is something to pay attention to, even though no one really cares about it right now.
Okay, so we'll continue to watch the Fed, see what happens today. These numbers today, how important are they? Or is this kind of just a passing moment where we're still looking at much broader issues, trying to figure out what the new incoming Trump administration is going to do with things before we really see what the Fed's next move will have to be?
So the Fed should wait to see what the policies are before they act. But the inflation stats today, the CPI number, and the payroll number that they'll get before that December meeting will come into their calculus. But the market's very 50-50 on whether they will cut in December. I think they're making a mistake if they do. Again, luckily, there's a meeting every 6 weeks, so they don't have gradual was the key word in yesterday's minutes. Well, if they're going to be gradual, then they should adhere to that.
Pause, you think? I don't think that's going to happen this go-round.
Yeah, usually they don't like to disappoint markets when we're at about 60%. So if we go into that meeting and it's greater than 50, they may take a pause. They won't take a pause. They'll cut.
Right. They'll continue to cut.
Yeah.
The party that you mentioned in the equity markets, these new highs that we continue to hit, why is that, and does it make sense to you?
So positively, the market has discovered that there are not just 7 stocks in the stock market, that there's another 493 in the S&P, there's another 2,000 in the Russell, and there's also mid-caps. That transition happened in July when investors started to sort of separate out the AI trade and realizing that these companies, the hyperscalers, are spending $15 to $20 billion a quarter, and we need to see, show me the money and returns on this. And then all of a sudden markets started to say, hey, there are other stocks to buy, and that's what we've seen, which is a good thing. But the party's going on because they think the Fed's on their side. Trump obviously is going to bring a business-friendly mentality to the markets. Credit spreads are extremely tight, and everyone just believes in this soft landing and everything is going to be fine. But at the same time, the S&P 500 is trading at 23 times forward earnings.
Yeah, we're above 6,000 now.
We traded 24.5 times in March 2000. So that valuation rubber band is getting stretched. At the same time, interest rates are staying high. So we'll have to see if this plays out.
And that was different. In March of 2000, that was these crazy valuations based on companies that had no earnings. This time, you can look at these companies and say they have earnings. They have staying power. But your point is it doesn't really matter, that once you get stretched to these levels?
Well, valuations don't matter until they do.
Yeah.
If interest rates stay high and trend higher, I think the 10-year is going back to 5% at some point next year. That will be a test for those high multiples. But those multiples are very concentrated on the biggest names. Luckily, there's value in other parts of the market.
So you would tell people to buy, just be choosy in what you're buying at this point.
So we are still buying things, but I am trying to find other parts of the market where there is value, where that's not partying like the rest of the market, like commodity stocks, like energy stocks and oil and gas and agriculture and even gold mining stocks that sort of have been out of this party that's taking place in other parts of the market.